According to the National Association of Realtors, inventory or the number of homes for sale was up 18.5% compared to May of 2023. Meanwhile, the number of sales was down 2.8% compared to a year earlier. Mortgage rates for a 30-year fixed-rate mortgage is near 7%. We have increasing inventory, decreasing demand, and home affordability is at all-time record low. However, last month, the national median sale price for an existing home was at an all-time record high of $419,300. Now, how is this sustainable? How can prices keep going up with fewer and fewer people who can afford to purchase a home? The question on everyone's mind is, when is the market going to crash? If you like to follow real estate on YouTube, there have been those who have been calling for a crash in 2020, in 2021, 2022, 2023, and 2024. Yet prices continue to go up. Will there be a real estate crash? Will some markets see price declines? Now, that's the nature of any market. Prices go up and down based on supply and demand. When you have low supply and high demand, prices go up. Likewise, when you have high supply and low demand, prices decline. Again, real estate markets are local. Even inside a local market, like Omaha, Nebraska, we have different price points and they behave differently. For example, if you're an entry-level buyer looking for a starter home below $250,000, you'll still see multiple offers on properly priced homes in great condition. If you're at a higher price point, you're going to see more price reductions and homes are taking longer to sell. Everyone uses the Great Recession of 2008 as their frame of reference. Since prices declined in 2008, history repeats itself. What goes up must come down, right? How can home prices continue to go up when you see inventory increasing and demand decreasing? Many people right now are struggling just to make ends meet. According to the U.S. Census Bureau, the median household income in the United States is $74,580 per year. Can the median household income afford to buy a median-priced home in the United States? And the short answer is no. The question is, who is buying these homes? Somebody is out there buying homes. And sometimes you have to look past the headlines. For example, inventory in my local market is returning to pre-pandemic levels. Now, that's not a bad thing. During the pandemic, we had unhealthy low levels of inventory. During the pandemic, we had record low interest rates. We shut down businesses, we kept people locked down in their homes, and then builders had problems building homes because of supply chain issues. Then the government turned on the printing press and printed more money. Now that's all going to fuel inflation. Home prices went through the roof, and the state of Nebraska, the home prices were up 48.1% since the pandemic. At the time, Jerome Powell and Janet Yellen told everybody that inflation was transitory. Well, guess what? It wasn't. Inflation is a hidden tax. Inflation is when too many dollars are chasing too few goods. When the government prints money, it causes inflation. Now we're paying the price. For every gimme, there's a gotcha. In order to curb inflation, the Federal Reserve had to raise the federal funds rate. When they make it more costly for businesses to borrow money, it slows down the economy. If the government does not get a hold of inflation, then we really have problems. Runaway inflation leads to civil unrest. You saw runaway inflation during the Weimar Republic in Germany in the 1920s. Today, we see countries like Venezuela and Zimbabwe with runaway inflation, and it causes some real issues. In fact, the Federal Reserve has two mandates. Number one, maintain maximum employment, and two, price stability, which is keeping inflation in check. We've seen this before. In the late 1970s and the early 1980s, we had inflation hit 14%. What did the Fed do? Well, the Fed chairman at the time was a guy named Paul Volcker. He became Fed chairman in August of 1979. He raised the federal funds rate to above 20%, and it killed inflation, but it also killed the economy, and we went through a severe recession in the early 1980s. Where is the Fed funds rate now? Today, the Fed's fund rate is around 5%. Inflation right now is at 3.3%, which is down from June of 2022 when inflation was at 9%. We're making progress and we're going in the right direction. Now, does that mean we have a healthy economy right now? No. Do we have a healthy housing market right now? And the answer is no. And it's probably going to take years to work our way out of this. However, there's always going to be a housing market because whenever someone has a baby, when somebody gets married, when somebody gets divorced, or when somebody passes away, it creates a need for a housing market. One of the misconceptions about interest rates is the Federal Reserve does not control mortgage interest rates. Mortgage interest rates are influenced by the Fed's fund rate, but the Federal Reserve does not control mortgage interest rates. Mortgage interest rates are tied to the 10-year Treasury yield. When mortgage interest rates go up, homes become more unaffordable. That means fewer homes are sold, and when fewer homes are sold, it slows the economy. Because interest rates were so low just a few years ago, many sellers are reluctant to sell because they would be selling a home with a 3% interest rate and then buying a new home at a 7% interest rate. This means fewer sellers in the existing market, which is keeping existing home prices higher. Another factor in keeping prices higher is the fact that during the past decade, fewer homes were being built. Many builders learned the hard way during the GFC. Builders only build a home now if they already have a buyer and a contract in place for that particular home. Prices also went higher because it simply costs more in terms of regulation. As more and more regulation goes into the development of the ground and more regulation goes into building of the home itself, it causes prices to go higher. Today, regulatory costs to build a new construction home in 2024 is currently estimated to be around $93,870. All of these costs get passed along to the consumer. Now, do we have an affordability crisis? Yes. Homes are more unaffordable and fewer people can buy them. Home prices have gone up. Everything has gone up in price. It's not because items are worth more. It's because the dollar is worth less. Inflation causes the purchasing power of the dollar to go down. What should you do? Well, for number one, don't listen to anybody on YouTube. Don't let anyone, especially from YouTube, talk you into or out of what you feel is best for you and your family. Everyone's situation is going to be different. I'm a big believer of living within your means. If you can't afford something, then don't buy it. You're going to have to save your money. And if you think the government is going to be coming to your rescue, well, then good luck with that. Should you buy a home right now? Well, if you can afford it and if you plan on living in it for at least 5 years and you have a stable job situation and you have some money saved up in case you hit hard times, then go ahead and buy. There's never a perfect home, and the perfect time to buy a home doesn't exist. Real estate sells for market value. You have to live somewhere you can rent or you can buy. Let's say you decide to wait for the market to crash. And let's say you're on the sidelines and you're going to rent, and we're in the Omaha area, so I'm going to use $2,300 for a monthly rent. Now let's define a crash of a 20% decrease in value. That means a $350,000 home today with a 20% decrease in price would be $280,000. So you decide to rent a home for the next 2 years at $2,300 a month. $2,300 times 24 is $55,200. You spend $55,000 waiting for a crash. If you purchased today, you bought a home for $350,000. You come in with 20% down payment, which is $70,000. You financed 7% for 30 years. And your monthly payment, and this is just principal and interest, would be $1,862.85. But let's say you decided to wait for the crash to happen, and the crash happened. Your $350,000 home is now worth $280,000. So you have a purchase price of $280,000. You come in with 20% down payment, so you only have to come up with $56,000. You financed 7% for 30 years, which your monthly payment, principal and interest, would be $1,490.28. So you save by waiting $372.57 per month. So let's look at the math. You saved $70,000 off the purchase price, and you saved $8,941.68 for a total of $78,941.68. But you had to spend 2 years waiting on the sidelines paying rent, which cost you $55,200. Your strategy to wait for the market to crash was a net savings of $23,741.68. That's if you timed the market perfectly. But what if you were wrong? What if you happened to decide to do this 3 years ago? You'd be pretty disappointed. All of the people who overpaid for their home in 2021 now look like geniuses now. Fact is, nobody can predict the future. What are prices going to do? What are interest rates going to do? Nobody knows. Ask yourself this question. 10 years from now, do you think home prices will be higher or lower? Even if home prices take a hit, write it out. Let's say you purchased a home in May of 2004, 20 years ago. The median sale price in the Omaha market was $137,900. 5 years later, the median sale price was $138,000. You would have had a whopping total of $100 in appreciation in 5 years. You wrote it out, and in May of 2014, the home was worth $155,500. Even in the GFC, the Omaha market did not take that big of a hit. Fast forward another 10 years. What is the median sale price of a home in the Omaha area in May of 2024? $325,000. If you're on the sidelines, make sure you're waiting for the right reasons.